Let's do that problem again, only do it perpetual. Here it is. So here's perpetual inventory. Notice that we have a chronological flow of our buying and selling. So we may have this information up here, but notice that we record it on a perpetual basis, so we always know the value of our ending inventory, and we can always compute what cost of goods sold is at any moment in time. So notice I've converted this to that. Now let's look at the journal entries. On January 4th, we had a sale. Under perpetual, there's two journal entries whenever there's a sale. One, to record the sale, which is debit accounts receivable, credit sales. And the second is to record the cost of what you sell by debiting an account entitled Cost of Goods Sold and crediting inventory, the asset. So notice each time you make a sale, you're moving the cost from the inventory account into an expense account known as Cost of Goods Sold. So again, the sale was for 80 units at $8, or 640 was the sales price. Now under FIFO, the first units in are the first units sold, so we take 80 of the $5 layer out, and that is $400. So we debit cost of goods sold $400, we credit inventory $400. That's the first sale. Then on the 11th, oh, that was on 1/4. So on 1/11, when we make a purchase, we don't have a purchases account. Instead, we flow everything through the inventory account by debiting inventory and crediting accounts payable for the amount of our purchase. And our amount of our purchase was 150 units at $6, or $900. We have our second sale on the 13th. So again, it's going to take two entries: debit accounts receivable, credit sales, and debit cost of goods sold, credit inventory. The amount of the sale on the 13th was 120 units, $8.75 each, or $1,050. Whereas the cost was 20 units at $5 plus 100 units at $6, or $700. Notice in each of these cases with the sale, I can always figure out what my gross margin or gross profit is for that particular sale. On the 20th, we have another purchase, so we're going to debit inventory, not purchases, and credit accounts payable for the 160 units we bought at $7 each, and that is $1,120, or $1,120. And finally, our last sale on the 27th of January takes two entries: debit accounts receivable, credit sales, debit cost of goods sold, credit inventory. The sale on the 27th was 100 units at $9 each, or $900. And the cost of goods sold was 50 units from the $6 layer, first one's in, first one's out, and 50 units from the $7 layer, which comes to a total of $650. There's no need for an adjusting entry, so no HAE. to put the proper amounts in the inventory account, because as we can see, inventory keeps an actual running total of what the cost of ending inventory is. So to figure out cost of goods sold, we could add up our cost of goods sold accounts, or in the table, you would figure out what this value is, and notice it comes to $1,750. Sales, we knew from our journal entries, and we know our cost of goods sold, and so notice our gross margin is $840. It's the same as it was under periodic as it was under perpetual, given the flow of the goods through the system. So I hope you found that helpful. Periodic versus perpetual journal entries.